we going to get 5 hikes this year?
Not looking that way right now. It was a risk at the time. I think the data have certainly softened. Now, Carl is my favorite Bloomberg economist, but let me take issue with something. I don't think
take issue with Carl. Go on.
I don't think the Fed is on the verge of scaling back the rate of the number of rate increases we're going to get this year. They're not about to jump forward either, and certainly the most recent data have been on the soft side. But working in the background here is a labor market that is tightening impressively. Yeah. It's not yet super tight. Okay, we're not there yet. But at this pace, and if you believe the Fed staff forecast, which says that GDP growth is going to exceed potential for the next 3 years, we're going to be down to a level that's that is going to begin to have some real impact.
But it's your second point that's critical. It's not a Federal Reserve that looks like it's going to speed up anytime soon. And we're starting to learn something about the reaction function, Robert, of the Federal Reserve as well. They're very calm about an inflation pickup. They're not looking to get out ahead of it in any kind of aggressive way.
Yeah, honestly, at this last meeting with the announcement, I was really surprised because the history of the Fed is that they're calm until you get to target or they think they're behind. And I was ready for them to signal maybe they were going to shoot for 5 this year. If there was a point where they were going to signal that, it would have been the last meeting because they were at target. They're still very accommodative. They've been waiting for the rise in inflation. They're getting it. Maybe it's time to speed up, and they didn't. And so, my guess is if you think about making the case to head the Fed now, I think this is a different Fed, a little bit than what we saw before.
What's different?
I think the Yellen Fed wanted to make sure that there were no bubbles, that they were not overly accommodated, because if you let a bubble build in the system and it crashes, that is the worst thing for Main Street in the long run. And so I think this Fed, and the Yellen Fed had made the case 2% is a symmetrical target. But you look back at the last 10 years, we had maybe 3 months where core PCE hit or exceeded 2. It averaged about 1.5, and there was a cost. So I think this Fed is really trying to walk the walk of we're going to let this run around 2%. And I think that opens the door that after the next couple of hikes to get to 2.25, you're near our star, they may need to slow down. If, for example, energy prices drop off and the inflation numbers drop away as they have so often before.